again, if you own it personally, you will be taxed because you chose to own it personally. And so there's a famous person, John Rockefeller, he said, he was famous for saying, own nothing, control everything. So he didn't own it, but he controlled it. And so there's a structure, it's a trust structure. It's not a living trust. Most people are familiar with trust. They're familiar with living trust. They're familiar with different types of trust, revocable, irrevocable. There's a specific type of trust in the tax code that is able to own any capital asset, Bitcoin, crypto, NFTs, rental properties. It doesn't matter what the asset is, but you can actually buy and sell even on a daily basis. You could trade your Bitcoin for Ethereum. You could buy NFT here, sell the NFT, come back to Bitcoin, go back to cash, go back to another NFT, all in one day, and never create a taxable event. And the way you do that is through two things. Number one is case law and tax code. So if the case law agrees with what you're doing and the tax code agrees with what you're doing, the tax code specifically says for this specific type of trust, it says gains from the sale or exchange of capital assets shall be excluded to the extent that you allocate to corpus and you don't pay credit or require distribution to a beneficiary. Now, that's what the tax code says. So you have to understand that if you're the one that owns the crypto, you're going to create the gain, right? But if the trust owns the crypto, you're not creating the gain because it says gains from there is a gain. It just says the gain is excluded. In other words, it's not considered income. So we use tax codes for everything we do. Everything is compliant. We have enrolled agents. We have CPAs that work for us. But you have to understand the code. And so we have a booth back there. We have 10 or 15 consultants back there. You can go and ask them questions, and they'll help you. They'll give you a brochure and stuff. But the main thing is
let's do a real recap, because I know that was a lot of information.
Yeah.
Because I'm sitting here, we just talked about it before, and I got smacked with the same information again. So I think the biggest piece here to remember is that although crypto and NFTs just came into existence, relatively, within the past few years, capital gains tax has existed, before that, and there were always ways to avoid capital gains tax. And so what Nexus does, specifically helps you avoid those capital gains tax, and now they're just applying those techniques to crypto. And so I think that's the big key that we need to understand is that through the use of these trusts, they're able to reduce your tax liability on capital gains, tremendously.
Yeah, absolutely. I also just want to go back a little bit to, like 101. So maybe some people just don't understand the kind of the basics. So if you have two types of capital gains. You have long-term capital gains and a short-term capital gains. So if you are holding anything less than a year, it becomes a short-term capital gains, and it's going to be taxable as your ordinary income depending on your tax bracket. So that's can be very different from very people. But if you hold it more than a year, depending on where you are in your bracket, you might not have to pay capital gains as well. So there are also just basic rules. But also when you know that you have taxable event and you own a lot of different assets, that solution of the trust is a really amazing solution. And to me, a lot of people don't know that it exists. So thank you so much for actually going in detail about it.
Yeah, and I think we're definitely going to open it up to question and answers later. But I think we also should bring it back a little bit more too, just with the regular person, right? Because I would assume, and obviously I know the answer, but I would assume that these trusts for a regular person seems like, what does that mean? What can I get that? I don't know, right? And so some other ways that you can avoid capital gains tax without having to use trust, right? Through gifts, through donating to charity. Specifically with crypto is allowed that you can donate your crypto through charity and not get taxed on the receipt of that crypto or the gain on that crypto. And so that is and you can still get that deduction, on your taxes as well. And so there are many ways that you can go about reducing your tax liability. But again, this way, and Scott actually introduced this thing to me, and I was like, wow, yeah, I didn't even know about that. And so number one is so many things that you can learn and so many things that you can do to reduce your tax liability. And the people are out there, right? You know, and it's a solution for every bracket. It's a solution for every person and every, you know, instance and every business. So definitely just wanted to point that out, that, you know, even if this is not your solution, there are plenty of other solutions to help you reduce your taxable income.
And also a lot depends upon the jurisdictions, because you have to really know each country's, each laws. For instance, you know, Germany doesn't have any crypto taxes. Singapore does not have capital gain taxes. Malaysia doesn't have them. So depending where you go and where you're based or where you have your residency, different laws of course apply. And we're focusing on US here primarily. Also, I want to say that, you know, even you think that your, you know, crypto is completely anonymous, a lot of times it's not the case. And even like last year when you file tax, you probably see a checkbox if you do anything in crypto. Don't take it lightly, because IRS does look at it. And you know, there will be taxation, there will be consequences. So it's always better to keep a track of all your trading activity, put in an Excel spreadsheet, give to your accountant. But always don't try to hide anything, because that can backfire. There are legal ways of doing it, right ways of doing it. Don't do the wrong way. Also, there's such a thing that's coming up, which is in discussions right now. With I know FATF and you know, travel rules. So very soon, a lot of countries might be implementing. Some already have. If you are sending money to another person, the three questions come about: why you're sending it, where you did it get it from, and what is the wallet address of the person you're sending it to. It's still not quite utilized yet, but I think they're saying next year it will be in many different countries. I mean, like, we're actually in strongnode.io, we're doing the Strongnode ID that will actually help us, help anybody to get their KYCs in place, because we just believe that that's going to be the future. Crypto is going to be more about transparency and easily adaptivity of the global carrier, but not about hiding things.
Thanks. Very good. Thank you for that information. And so one thing I will say about I'm going to have April and Tom also talk in a minute. Tom is an enrolled agent. He was with our company, and he can answer the specific IRS questions about our trust. And so he's here to help. And then April, she runs all of our California office, 2 offices we have. So, but I just want to explain real quick. If you're taxed on your crypto, think about this for a minute. If you're taxed, I want you to understand why you're taxed. You're taxed because you own the crypto. And so, and some people are like, well, how do I buy trust? I don't have the money. I thought only rich people have trust. And so, again, it's not just any trust. It's not a living trust. It's not a revocable trust. It's not a grantor trust. These are not, if you call up any attorney in wherever you live, chances are they're going to lead you down the road of either a revocable trust, a living trust, or a grantor trust. One of those different versions, okay? Those are the wrong types of trust to have the tax benefits that we talk about. It has to be a specific type of trust. It's the type of trust, our trust is, the trust we have has been around for almost 500 years. It's been around forever. It came from England. It's a special type of spendthrift trust. But one thing to think about though is why were you taxed? You were taxed because you created a taxable event. Now, our trust, when it buys and sells, it doesn't create taxable events. And it doesn't create a taxable event because the code itself, the IRS code, says that it's excluded. The exchange, when you buy and sell something one for the other, it's excluded. In other words, and it also says not considered income. So not only is it excluded, it says it's not considered income. And so there's a lot of things around this trust. You're going to have questions about it, and you know, yeah. And so April, go ahead.
So one thing, because I know there's a lot of information here, and it may be the first time they're hearing just about trusts in general, right? And it's all about proper structure. Just know that you have a team behind you. We have a turnkey solution with our firm where we have the CPAs, the enrolled agents, the accountants, the bookkeepers that help set up, help buy and sell your assets into the trust. You have full protection and you have full control. You're the puppet master, right? You control. You just don't own it. Your trust owns it on your behalf so you can get the tax favors. So just know that you have a team behind you. You don't need to know all of this. You don't have to be the subject matter experts. we can be that for you, and you can lean on us. We're not just going to sell you a trust book and be on your way. We've had colleagues, even in this profession, that were sold a trust, they were sold a book for a really outrageous price, and then they couldn't even find a CPA that understood how to do the trust accounting, and it just sat on their shelf collecting dust because they just didn't know what to do, and they didn't want to get into trouble, right, with the IRS. I mean, this is a big deal. And so just know that you have a full team behind you that's going to hold your hand, and it all starts with education. We don't know what we don't know until we're exposed to that. And, and that's what this is about today. So we're here to answer any questions and get you on your way.
So do you want to just go down? Or bring
one more
people
thing
up?
before we do question and answer. Remember this: an NFT is it can be considered intellectual property, and because it can be considered intellectual property, you have the right to not only the trust can own the NFT, but the trust or the trust. There's all types of ways, because it's intellectual property, how you're able to use that to reduce your taxes. And we have. Go ahead and ask your question first.
No, I was just going to ask if we wanted to go down into the audience or have people come,
Okay.
up to ask their question.
So now, Manuela, she's here. She. If you have a specific question, raise your hand, or maybe how about just come up here next to Manuela over here, and then she form a line or something. But before I answer the first question, I didn't even know he was coming, but I have one of my clients. He showed up here. He surprised me, but he was just wanting to listen. But he's a doctor in Beverly Hills. Okay, he's a liposuction doctor. Would you like to come up? Would you say something real quick? He's one of my clients. So go ahead,
Scott. All right. I'm not prepared, so I'm just going to speak to you from my heart. I have my trust. I've had my trust with Scott for about a year. I can tell you this. I wish I had my trust about 2.5 years ago. It would have saved me $150,000. I am a physician. I'm a cosmetic specialist in Beverly Hills, and this is LA Hollywood. So I invested in the movie, and I was one of the LLC partners. The LLC got into a lawsuit, and they couldn't go after any other member in the LLC because none of them had any assets to go after, so they went after me and my house. And so I ended up having to pay the entire judgment for all the other partners because my house was being threatened. If my house had been in the trust like it is now, I could have saved myself $150,000. That one thing alone would have made this trust worth it. But I can tell you this, right now my house, all my art, all my cars, the IP, the intellectual property for my practices, everything is in my trust. I control all of it, but no one can come after me for anything anymore because I have nothing. I have nothing for them to come after. So that's one huge benefit of this trust, is what we call asset protection. And then the other big benefit is the tax deferring. I've been able to put a lot of money into the trust for my children. I have a 4-year-old and a 2-year-old, and a 12-year-old, and now I can fund their college education without being taxed on the money that comes out of the trust, paying for their education, and that's written in the tax code, and that's a huge thing for me. In essence, in my mind, I'm thinking I'm preparing things for my children, my children's children, and for generations to come, just building wealth, building wealth, building wealth, tax deferred out of the trust. So it's been really great for me.
Thank you so much. Thank you so much. Dr. Hashman in here. He's in Beverly Hills. But all right, let's do some question and answer. I do have Tom here, and we also have a CPA, enrolled agent, and multiple people to answer the questions. So if I'm not going to answer all of them, but I will defer them to someone else.
No, Scott, you have to answer every one of them.
All right, this is going to be a multiple question with A, B, and C to fill out.
Okay.
My partner and I, we're about to release over the course of the year about 200,000. Can you bring the mic up just a little bit? My partner and I are releasing about 200,000 NFTs that we hand draw.
They can't hear you. There you go.
Is that better? Okay. My partner. My partner and I are releasing about 200,000 NFTs this year. We hand drew each, and we're putting our team together right now. What you said is very pertinent because he's in and out of the country, and he's from Italy, and I'm from here, and I wanted to set up a trust for him and me and pretty much all my team, so the money could go into the trust rather than come to us. So I didn't actually know how to do that. Is that something that you can do for like an entire team then this out?
Well, there's two different dynamics going on in your situation. Number one, I think you're operating a business, and then so there's two different topics here. Am I personally investing, or is my business operating a business? So that we have to separate the two. Like in other words, if I was to invest in an NFT or invest in something, I want to put it in my trust, and then my trust invest. But if you're operating a business where you have employees, you have payroll, you're actually operating a business. That's a little separate, different topic, which we can still help you. We actually have a business trust that can run a business like that. And so I would have to really discover how your structure is before I can say, hey, I know the trust will help you. I know you can invest in the NFTs personally and not be subject to these certain taxes. But I have to really know your structure.
Actually, right now, the structure is two crazy artists that was locked in a room for about half a year creating stuff.
Okay.
That's the best type.
So it kind of depends real quick, if you're operating a business. If you are, you can use an LLC, you can use any type of business structure you want. What we do with our trust, though, is we show you how to turn your active income into passive income. As long as it's passive, it can come into the trust, and it can be deferred for the next 1,000 years, basically, which means the IRS code says not considered income. So yes, you can do your NFT project, but we have to know the structure. Are you operating the business, or is it personal investment?
Well, I guess a better question is, you could set up a business trust, but then for each part of our trust, like a royalty catch-all for the trust fund, because that's really what I was concerned about.
Right, and that actually brings up one of the questions that they're going to ask about what are the types of income that are not taxed in the trust. And so that was one of the questions that they had asked earlier. Can you explain?
Yes, so there's 6 types of income that the IRS does not consider taxable if structured in a trust properly. Those are capital gains, royalties, rental income, dividends, interest, and
We just gonna say tips, okay? But to the point, right? With the NFT specifically, you have all those different elements, kind of playing a part depending on how you created it, right? You might have a royalty component, capital gains on the sale of them, and so to that point, having the trust and utilizing that, for the NFT project could save you, your business and you individually, the owners individually, a lot on taxes.
Excellent. So royalty is one of them, but the one she didn't say was K1 passive income.
Oh, yeah.
So rental income, interest, dividends, K1 passive, and capital gain. So capital gain income is one of the 6 types of passive income that when that income comes into the trust, it's not considered income according to the IRS for this specific trust. So, but you did mention royalty. So if it's a royalty, it comes in the trust, not considered income. The IRS code is very black and white about it's not being income.
And I have a second question then, with what you just said. So say that
You just got to get out of the venue.
we're not releasing, of course, all 100, 200,000 NFTs at the same time. That would be crazy.
Right.
But at the same point in time, we each have our own ones that we did. Could we keep the ownership of those NFTs in the trust, because they will accrue value before they're released?
Okay. There's so many options there.
Okay.
You can do a lot of different things, and it depends. I mean, it depends on are you going to pay a dividend, or what?
I don't know all that yet.
Okay, so yeah, there's a lot of variables there, and Tom is really good at going over all those different variables. But if you would, I mean, you can tell us your structure. We'll show you all your variables.
Yeah, I'll come to your booth later.
Okay. Anyone else have a question? If you have a question, let's let Manuela. Someone ask a question.
You got
Any tax crypto question?
Or, any questions, life, you can answer some of that.
How you guys doing? One question I had about the NFTs is, if I'm purchasing it from a marketplace and I'm using my seed phrase, etc., how is that tied into my actual trust? Because the NFT itself is purchased through my MetaMask and my seed phrase. It's not. I don't have my physical name on it. So how is that tied into the trust?
That's perfect, because if you bought it, if you purchased into an NFT, that account that owns it, has the ownership, is either you as a person or you are acting on behalf of an entity. So as long as the trust owns the money that invests in the crypto, now all of the profit or gain is not considered taxable in our trust. But you have to remember, if you invest, you're taxed. If the trust invests, it's not. The IRS code says not considered income. So you have to separate you have to decide who's the one investing. And so what you do is you have the money in the trust sends the money, not if your personal bank account sends the money to invest, now you were the investor, so now it's taxable. If the trust sends the money, the bank wire from the trust account, now the trust is the investor. And so it all depends on where the money comes from, basically.
So if I currently own an NFT, would I be selling the ownership to that trust?
Yeah.
Okay.
Any other questions? Okay. Yep.
So if you have assets, real estate, that goes into trust. Does the cash go in the trust?
Any asset you personally own, it doesn't matter if it's a rental car, a rental house, any property or crypto or NFTs, doesn't matter what you own. You can sell everything you own to the trust, where you own nothing and control everything. You don't control it in your personal accounts, you control it in the trust as a trustee. So anything you can imagine, if you can buy it as a human, you can buy it as a trustee. If you can sell it as a human, you can sell it to the trust, let the trust own it, yes.
So when you set up the trust, you transfer the cash, the assets, everything in the trust?
Yeah, everything, yeah. Because remember, own nothing, control everything. If you own it, guess what? You don't have control, because if I can sue you and take it from you, then you don't have control. The courts have control, right? So own nothing, control everything means everything you personally own, all worldly possessions, all crypto, all everything. You don't want to own it because now you can lose it, right? So let the trust own it. No, you can't sue the trust. It's a spendthrift trust that doesn't hold the equitable title to the assets. That's why you can't sue the trust. And so, so not the wealthy, but the ultra wealthy use these trusts because they buy and sell, they flip hotels, they flip large entities, and the code is specific on capital gains. Gains from the sale or exchange of capital assets are excluded. They could flip the hotel on a weekly basis, or big assets, big crypto accounts, never be taxed on it. And so that's...
So let's say you're not married and you set up the trust and then you're married. It's not common property?
So you're not married and then you get married and then buy the trust?
No, the trust is set up and then you get married.
Oh, okay. So you had the trust before you were married, right? Well, you have assets, so you can, when you sell those assets, whoever signs the bill of sale has to be the owner of the asset, right? So if it's a marital asset, both of you need to sign the bill of sale to the trust. But if you have assets before you got married, you can sell it to the trust, and because you owned it before you were married, you can sell it to the trust, and you only need one name on the bill of sale. So
it doesn't become common property once you get married if the trust existed.
Yeah. So if you make your spouse, like my wife, she's a trustee in my trust. We own everything in our trust. We own together, or we don't actually own it. The trust owns it. By the way, the trust, you can't own a trust. Remember that. If it's in the trust owns it, not you. But you can control it. My wife and I control everything together. Okay.
So I think that's the question, right? I think your question is the property's in the trust. you still have control of it, but technically you don't own the property, right? And so from that logic, it can't be common property with you and your spouse because you don't even own it. But you have the control, and maybe you put her on, later, or maybe not. Maybe that's the question. And so, from what I'm hearing, it's able to, keep that separate because again, you don't even own it at that point for it to be common.
All right. Thank you.
And also, let me state for the just the benefit of everybody on the stage, we are not providing financial advice. All of that advice would be needed to be book individual consultations with us, and then we can definitely help you out there. We have a question. Oh.
Oh, hi there. Hi there. Sorry, just another topic away from the trust. More on the kind of DeFi and NFT staking. So, when you generate revenue from that, are you taxed immediately or only on harvest? Like that's one of the things kind of trying to figure out.
Yep. So the question was, if you are, if you have DeFi and you're earning interest essentially on that DeFi, is it taxed immediately or is it taxed when you withdraw it? Correct.
Correct.
Yeah. Okay. So again, there's no real stating yet in the IRS code specifically about DeFi transactions. They talked about crypto, and you can really translate that thought process to say that at the moment you earn it, that is when it is taxed. Again, the concrete, actual law and code has not come out. I always say better safe than sorry, and recognize it at that point of, when it was generated, right? So if it was generated on that particular day, that is ordinary income for you earning that interest income for that. And then if you ever use it at the time when you withdraw it, there might be an increase or decrease in the actual value of the crypto that resulted. If you're bringing it out into cash, then you also have that capital gain or capital loss for that asset at the same time. So I think again, barring any rules from IRS, henceforth, you have an ordinary income at the point where you earn that interest, when you earn that staking income, and then when you eventually transfer that back into cash, or first into cash, you have that capital gain as well at that point.
Yeah, and also to add to it, because we've been talking about the capital gains, but also let's not forget about capital losses. Because you always want to keep track of all your capital losses as well and report them, because that will be, you can carry it as a loss carry forward, and then you will basically take it away from your profits as well.
And that's actually a good tax strategy right now. I think it's being debated, and so we'll have to see, specifically, when the amounts are being withdrawn. But tax loss harvesting is still a thing. It's different. There's no wash sale rules, or there are in certain cases. But so again, consult your accountant for your specific needs. But the whole wash sale rule with stocks, where if you sell something, you can't sell it, get that loss, and buy it back within 30 days. But as it stands, for crypto, that rule does not apply. So a lot of people are trying to take advantage of that. Yep, you got a question, right?
Is a trust able to build credit?
Yes, a trust can. A trust can have a credit score just like a person can. Yes.
Okay. Any other questions? And sorry if we start zooming through questions. We got the nod back there that we're.
How many minutes left?
3 minutes.
5.
5 minutes.
Oh,
okay.
5 minutes. 5 minutes.
All right.
Any other questions?
So this is kind of a two-parter. So just general, say you're transferring crypto from one kind of crypto to another. You're not actually holding any type of dollar amount. You're just holding that digital currency. So say I buy a Bitcoin and it's worth 20,000 today, and then I traded it for a bunch of Ethereum that are at like 1,000 a day. But then tomorrow they all accumulated, but I didn't cash out yet. I'm still in just Ethereum.
Yes, but because you're switching from one type of property to another property, that capital gain. So when you bought it, that Bitcoin at 20,000, whatever the value of that Bitcoin was on the day you traded it out for Ethereum. So say it was 30,000, you do have a $10,000 gain at that point, because again you're switching from one to the next. And now in real estate you can do like-kind transactions where that's not taxed, but in crypto it is taxed.
Just remember, the reason you have that gain is because you were the one that owned it. But if, like I was saying, if you let the trust own it, and even if the exchange sends you a tax document saying you had all these gains, whatever, even we don't worry about that. They can send those documents. We correctly file those documents with the tax return, and it's still, all the gains are still excluded, even if they send us the document saying how much gain, because the code says the gains are excluded for the trust. So yes, if you own it, you have the gain, you pay the tax, right? And you have to keep up with all that. And that's another thing. If you don't have this trust, you have to worry about depreciation. You end up depreciating everything you own just to save on tax. With our trust, you never have a need for depreciation because you're not creating the income tax to depreciate. Okay, so that's a beautiful thing. If you can own assets and never have to depreciate them, that's a big deal. And so now Tom hasn't got to say too much here, but he is a true tax expert with this trust. So you can definitely.
Well, one thing I'd like to say, you've covered the capital gains quite thoroughly, but also many of you probably have LLCs, and that can be merged with this trust as well, where we can defer a lot of the gains there, and so you can keep more of your business earnings and reinvest in your business or whatever you want. There's lots of ways. You have to look at your situation, and we can advise you, develop a real effective strategy, and so it passes the test.
And everything that I purchased like before as an individual, I could transfer that to the trust.
Yes, you would just sell it to the trust.
So we might have time for one more question. Okay, one more. I think I just squeezed that one out, my bad.
Let's say you open a trust and you have monthly income. How do you get the monthly income into your trust so that you actually don't own anything?
I think this is the question I asked you guys too about like the income, right? So she has monthly income coming in. How does she get that monthly income to go into the trust?
So it all depends on where the income's coming from. If it's coming from a business, we'll show you how to change that taxable income into passive income that's non-taxable to the trust. That's if the business has the income. But if it's personal income, like Social Security income, all that money has to come to you personally. But it can be put in your trust when it comes in. And what that does is called a double entry deposit. In other words, you deposit the money in the trust, but also now your demand note goes up. Because remember, anything you sell to the trust now owes you the money for. Let's say you have $1 million in crypto, you sell to the trust now owes you personally $1 million. So double entry deposit, meaning it's deposited into the trust, but now your demand note goes up also, and now the trust owes you everything you goes in the trust. The trust now owes you the money for. So, yeah, and it's.
Well, I think that we're definitely out of time right now, so I want to thank everybody for coming and joining us, and to thank you. And if you have any more questions, what's your booth number?
Say it again.
What's your booth? Where are you?
I don't remember the booth number, but it's a big booth with a big white backdrop.